The secular stagnation hypothesis was the idea that there has been a substantial decline in the real interest rate that is consistent with stable growth and full employment in our economies. It's been rephrased by many, essentially equivalently, as a sharp decline in the neutral real rate of interest. It seems to me that the evidence that there has been such a sharp decline is now no longer in serious dispute. And the most important economic paper I've seen of the last few months is a study out of the Bank of England looking very carefully at the causes of these declines in real rates and indicating that it does not expect neutral rates on a global basis to rise much, if all, over the next few years. What that means is that we are not saying goodbye forever to the zero lower bound and the problems that it causes. Indeed, for an economy like the United States that has a mature recovery, the odds that we'll be back in recession in the next 2 or 3 years are over 50-50. When we get to recession, we usually need 300 basis points or more of Fed easing, and there's simply not going to be room for that kind of easing.
There's no room to move.
So part of what secular stagnation means is that there isn't enough room for monetary policy to ease its way to drive recoveries. Part of what it means is that when we achieve adequate growth, we're likely to achieve it with very low rates, and those very low rates carry with them other problems like financial instability.
When I look at the international sense of Dubai right now, of course, reeling with Abu Dhabi from lower oil prices and lower iron ore, many will say it all hinges back to China. You've written much on China. Do you agree with the assertion that China drives the international debate right now?
I think China is an extremely important factor for commodity markets. Chinese demand growth has been the lion's share of the growth in demand for many different commodities. China, according to one calculation, laid more cement and concrete down between 2011 and 2013 than the United States did during the 20th century. That gives a sense of the magnitude of heavy investment in China. I think those days are gone. China is working to reform its economy. It's working to maintain growth. They may or may not succeed, but either way, they're unlikely, it seems to me, to generate the kind of growth in global demand for iron ore or oil that they once did, and I think that's got important implications for those commodity markets.
Then the raising of rates by Chair Yellen, Vice Chairman Fisher, and the others of the bank, and the vector or the presumed path of raising rates, how will that adapt or change China? Or within iron ore, how will that adapt or change Australia?
It can't be a favorable factor for commodity markets, and it's likely to add strain. Some substantial part of that strain, maybe all of it, has already been felt in the sense that the increase in rates has been telegraphed. And I think the people who are most alarmist about increases in rates do need to recognize that these are factored into markets to some extent, and so the extent to which there will be further effects really depends upon what surprises the Fed delivers down the road, not merely on its carrying through on the commitments that it's already made.